Here we start our Chapter 9, Part 5, our final part here. We're going to be talking about intangible assets and reporting of plant assets, natural resources, and intangible assets. What are intangible assets? Something intangible is something you cannot touch. They don't possess physical substance. They can be rights, they can be privileges, they can be competitive advantages. And below are examples of different assets, of intangible assets, and these are long-term assets. These are categorized as having an indefinite life, hard to quantify, almost impossible to quantify, or a limited life. How do you value intangible assets? You record them at cost. And again, all costs necessary to make the intangible asset ready for its intended use. But that is for purchased intangibles. If you have an intangible that's internally created, in general, you expense it. And we're going to walk through some examples in that. There are exceptions to this, and they are related to a concept called perfecting title. For example, you can capitalize the company can capitalize its own legal costs, the cost of its lawyers or attorneys, only if you successfully defend a patent. We'll go into that in a little minute. Amortization of intangibles. We do not call it depreciation, although it's a similar concept. It's another name for it, specific to intangibles. Limited life intangibles, we do amortize. We amortize them to expense, and we credit the asset account, whether it's a patent or a copyright, or we create another account, accumulated amortization. So for depreciation, we have accumulated depreciation. For depletion, we have accumulated depletion. And for amortization, we have accumulated amortization. Or more commonly, we just credit the asset account. That's an exception to the other methods, the other types of assets. Indefinite life, we do not write them off. They become like land, never written down. All right, let's talk about each intangible asset. And I'm not gonna hold you responsible for journal entries on the intangibles, but more for the concept, the definition of them, and the rules associated with them. What is a patent? If you have the patent, you have an exclusive right to manufacture, sell, control an invention for 20 years. So if a company internally develops a patent, they would write that off to R&D expense. However, if a company buys a patent from an inventor or creator, that patent would be an asset. So it all has to do with whether it was developed in-house or whether it was purchased from an outside source. So you would capitalize the patent. All the costs associated would go into an asset account called patent. That is an account. It would be categorized in the asset section of the balance sheet toward the bottom. And intangibles go toward the bottom of the asset section after fixed assets, and you'd amortize it over 20 years or its useful life, whichever is shorter. You are also allowed, the company is also allowed to increase the patent account by any legal fees incurred if you have a patent infringement and you defend and you're successful. Of course, if you lose that case, you would just expense those legal fees. So let's take an example. National Labs purchases a patent at a cost of $60,000. They estimate the useful life to be 8 years. Now, I just said the patent lasts for 20 years, but the company is taking what is shorter. By taking the shorter life, National is being more conservative, and they would record this as a debit to amortization expense and credit to patent. We're just going to credit the patent account in this case. That is really more common in practice. Copyrights. Again, purchased copyright gives the owner the exclusive right to reproduce and sell an artistic or published work. So if you write the novel of the century and you sell it to one of the major publishing houses, the costs they paid to you, they would capitalize in the copyright account. That's an asset account. Copyrights are granted for the life of the creator plus 70 years. Now let's say as an accounting instructor, I write a textbook and Wiley Publishers buys that from me. They buy the copyright from me. They're not going to amortize that over 70 years plus my life. Textbooks have a useful life of a much shorter time frame, 2 to 4 years. So it would be more conservative. They're going to have to take the more conservative choice and amortize the copyright over 2 to 4 years. What are trademarks and trade names? If I could see you all right now, I would imagine that some of you would be wearing items of clothing that have a trademark on them. Maybe it's your tennis shoes, maybe it's your hoodie that you're wearing, or maybe you're wearing a hat with a trade name on it. Trademarks have value, and trademarks are purchased. It could be a word, a phrase, a song, a symbol that identifies a particular product or a company. Again, 20 years. Trademarks or trade names have legal protection for an indefinite number of 20-year renewal periods. At the end of 20 years, you've got to renew them or you lose that trademark protection. You capitalize the acquisition costs and you don't have to amortize a trademark. Franchises and leases. Franchises, McDonald's, Shell, Taco Bell, these are all franchises. They are a contractual agreement between a franchisor and a franchisee. A franchise has a limited life and it should be amortized to expense over the life of a franchise. Most franchises have a limited life. It is possible you could get a franchise with an indefinite life, in which case you wouldn't amortize it at all. So what are examples? What are some facts about franchises? Franchises are one of the most popular forms of business in the United States, and they are the fastest business model growing. The advantage to going into a franchise for the new business owner are that it's a low risk, and the franchise owner has the parent company helping them. If you have a franchise with McDonald's, McDonald's corporate office will train you, help you get started. They'll give you, they do the national advertising. There's many advantages to buying a franchise as opposed to starting a business from scratch. Now, as of 2005, 71% of franchise owners only owned one franchise. 75% of the franchise owners had those for less than 5 years. 77% work more than 40 hours a week, and most work more than 50, many work more than 50 hours. 65% of the owners are between 35 and 54 years old. And the number one reason for buying a franchise is the same as wanting to start your own business. You want to be your own boss. You want to get more control. What do you think are the top franchises for 2005? Now this is kind of funny. Subway, which sells healthy fast food. Quiznos, which sells also healthy fast food. And Curves, which is a place to go to get fit. It's a health club. At this point, if you were in my on-ground class, I would ask you to raise your hands and say, which one do you prefer, Subway or Quiznos? And often the guys prefer Quiznos and the women prefer Subway. I prefer Subway too. And this is not good. You are not going to be tested on this, but whenever we talk about franchises, I like to look up what are the popular franchises. And you can see that for the year following, we had Subway, Pizza Hut, and Quiznos. So Subway and Quiznos were still there. 2007, Subway is still there. And now we have JanPro Franchising, which is a cleaning service, and Dunkin' Donuts. And 2008, Subway all the way across, and cleaning, and taxes, and more cleaning. So lots of cleaning services and fast food. And if you're interested in more about this, you can go to this website. And what's also interesting on this website is that it has the average startup cost. How much does it cost to start a Subway, if you're interested? Another intangible asset is goodwill. And goodwill is an interesting concept. It's a little bit tricky to teach at a financial accounting level. If you go on in accounting, you'll really do a lot more with goodwill. But goodwill is only recorded when one company buys another company. And it represents that intangible that you're paying for. So let's say you buy a company and you say, we're going to value all the assets, we're going to subtract all the liabilities, and what's left over should be the selling price. But the owner says, no, there's more to my company than that. There's exceptional management. There's a good location. There's a huge customer database. There's great employees. We have great products. Those things you don't quantify on a balance sheet, but you know they have value. And so goodwill represents the excess, the additional costs that the purchaser pays for the company over the fair market value of the net assets. And it does have value. Internally created goodwill should not be capitalized, even though, again, we know it has value. Now, frequently, companies have research and development. If you go to work for a company, you want to make sure that the company you go to work for does research and development. You don't want to work for a company that's just never going to come out with new products. And research and development costs are expensed when they are incurred, even though sometimes they result in new products, new processes, new ideas. They are expensed when incurred. There are exceptions to this in the area of software development, and you're allowed to capitalize at a point in the software development where it is, and the criteria is at the point the new program or the new software is technologically feasible. But in general, R&D costs are expensed. Let's talk about financial statement presentation and analysis. This is out of your textbook. This is a piece from the Procter & Gamble company showing just the long-term assets. You don't see the short-term assets. You don't see cash, accounts receivable, inventory. We're just focusing on the Chapter 9 long-term assets. So here we've got property, plant, and equipment, building equipment, land. You've got your total equipment at your original cost, less your accumulated depreciation and your net book value. And at this company, they have goodwill and trademark as their intangible assets. What do you not see at Procter & Gamble? They don't have any natural resources. So a common ratio in looking at long-term assets is net sales divided by average total assets. So you would say, for the money we're spending on assets, how are we creating sales from this? So divide net sales. Average assets is the current year plus the prior year divided by 2. We don't go back any more than the 2 years here. Current, prior, divide by 2. So net sales divided by average assets is about 60.6 or 0.59. So every dollar we invest in an asset produces 59 cents in sales. This concludes the video lectures for Chapter 9. I hope you've been following along with your course pack, and I hope you take the time to try that Maynard problem. The solutions follow. We have the straight line, double declining balance, and we have units of activity, also called production method. And this problem for the production method only asks for year 4 only. So we have 1 year of depreciation. We wouldn't know in year 4 what accumulated depreciation is because I only gave you data for 1 year, and therefore we don't know book value. Book value is also referred to as carrying value.